Yeah, hi everyone. So my name is Konstantin. As Zhenya mentioned, I've been doing valuation for some time now. I started off doing equity valuation, mostly concerning agricultural companies. The reason for that is that most public companies in Ukraine were previously in the agricultural sector and pretty much still are. There used to be, when I was still working as an equity analyst, there were about 10 of these in Ukraine. Now only maybe 3 or 4 are left. So the interest has dwindled, and that's one of the reasons why I switched over to fixed income. And right now I mostly focus on fixed income and actually macro as well. But the interesting thing is that a lot of what goes into evaluating equity is actually very similar to evaluating fixed income, and I think understanding the link actually makes you sort of gives you a different perspective on the way sort of valuation works and on the way things equities and fixed income is traded. So. The subject of the talk today is, as you can see here, is modeling and valuation of real sector companies. I'd like to start by maybe sort of getting a feel for the room. So those of you who have a lot of experience in valuation of equities, can you raise your hand so that I see how many of you are here? Okay. How about some that have modeling experience? That not that much, but have modeled before, know what the DCF does and all that, are comfortable with these ideas. How many of you are there? Okay, all right. So some of you, I guess, are really new to this. So the talk is going to assume that you are more or less comfortable with DCF and the basic things. So any questions that you have, just stop me. I'll try to explain them. I mean, the idea is here. So I will present a sort of a gathering of my experiences of what some of the better practices are when you do this, some of the pitfalls, what you should be avoiding, and sort of how you should approach the whole subject. So with that, I'm going to start. The first slide here is the sort of the layout of the talk so that you know what to expect. I'm going to start off with just some very general thoughts on valuation and forecasting. That's mostly addressing issues that I've met in the past with people sort of misunderstanding what valuation is about and having a wrong idea of what forecasts are and how they work. I'm going to talk a bit about that. Then I'm going to dive into modeling. I'm going to talk about the modeling structure, some ideas there, how what you would do if you have a big company, for example, with different segments in it, and just generally some general points. Then I'm going to talk about modeling in detail, and I think this is the question that any modeling practitioner always asks: is how detailed should my model be? I'm going to try and answer that as best I can. And then I'm going to talk about the valuation methods themselves, and this is going to be mostly concerning discount rate. Again, I'm assuming that you know what DCF is and how it works, and the big question is, should you be using the free cash flow to equity? Should you be using the free cash flow to firm? Which is better? Are they different? And then also, if I'm talking too fast, let me know, because if it's a bit hard to understand, I tend to talk a bit fast. And then I'm going to address some other common pitfalls which don't fall into those categories. And finally, I will finish with relative valuation, where you use multiples to value companies. All right, so let me start. The first topic is the general thoughts. So 2 ideas here that I wanted to talk about. One is that a lot of people tend to view valuation as a number, right? Is answering the question of how much is a company worth. And fundamentally, I think that this is sort of the wrong question to be asking, because valuation is more of a tool or a method rather than a single figure, right? Because anytime you say something, a company is worth 100 million, right? You're always assuming quite a bit of things when you say that, and really the number itself is not that meaningful, because someone else who uses a different cost of equity, for example, right, or assumes different capex, or assumes different working capital needs, is going to come up with a different figure, right? So, what the value of a valuation practitioner is shaping the method by which you can go from your inputs into your equity value. And that, I think, is very important to keep in mind. And I'll just mention this from my experience. When I was working as an equity analyst, I was speaking to different portfolio managers. They were calling analysts and asking, "What do you think about this company? And then you can distinguish between sort of the good ones and ones with less experience. Is that a good portfolio manager never asks you how much a company is worth or whether you think you should be buying it or selling it. It doesn't really matter to them, right? Because every person that makes an investment decision will have their own inputs, right? So they don't really care what your figure is. What they care about is, does your method, do you have anything in your method they don't have? Are you accounting for something that they are not accounting for? Can you give them an insight that they don't already have? And I think that's sort of the key to valuation, and that's the key to why we are doing all of this. So that's the first topic. Another sort of general observation is that, and I think it's particular to equity practitioners that are dealing with real markets, right? But it also applies to sort of any other comparisons. Is that when you value something, right? When you value an asset, and you have a benchmark that to compare it to, for example, this market value, right? You should always be asking yourself, is there a reason why my valuation is different from the market? Because you sort of meet this quite a bit, is that we have an analyst that says, we should be buying this company because the equity value that I have calculated is 20% higher, and the market is valuing it at this level. So therefore, it's more expensive, it's undervalued on the market. So let's buy the company. But the question that you should be answering is, why is there a difference, right? Why have you valued the company at a higher level than the market? So what is it that makes your valuation different? Are you assuming something different? Are your inputs different? If they are, why? Why are they different, right? So maybe, I don't know, maybe you are assuming a really high growth rate. Maybe you're way too optimistic and the market isn't. Because you have to understand that when you look at a market, and especially if you're looking at a big market, if it's a company that's traded by thousands of people, each and every one of them has an opinion of what the company is worth. And when you go out there and you say, I disagree with the market, you're disagreeing with a body of investors, right? And when you're doing that, you have to understand what you're disagreeing with. Why are you saying that the company is valued differently? That not only can it sort of pinpoint to maybe your errors, right? It can also tell you, are there any triggers for the value of the company on the market to grow towards your fair value, right? What is it? So if, for example, right, some examples that apply to Ukraine actually, is that market participants can be lacking the information that you have. And this applies very much to Ukraine, because a lot of people that trade Ukrainian equity abroad, right, and we're not talking about the local market, they don't really understand Ukraine as well as people that are living in Ukraine. They don't have as many details. They don't speak the language, for example, right? So they can't keep track of news, and you can. They don't speak to the companies, and you do, right? So you have more information, and then so that's sort of a general sort of picture. And actually, if you look at this actually works in practice pretty well, because if you look at interest rates that are that apply to Eurobonds, for example, to Ukrainian bonds, the rates there are higher than locally. One of the reasons is that Ukrainian risks are rated at a higher level from abroad than they are from inside the country. And the other example is maybe the market participants have, they don't have the same resources dedicated to valuation. They don't have the same amount of people and the same amount of detail that they have access to. So think about that whenever you do it, and also when you compare yourself to other people, right? So if you have another person, you have another bank that has valued, you're doing an M&A, for example, right? And you have, or you're doing an IPO, and you have another bank or another analyst giving a different valuation to your company. Always ask yourself, what is the difference, and what kind of inputs are they, using that I'm not using? So, all right. So now I'm going to dive into modeling. It's sort of a bit abrupt, but we're just going to jump into it. I'm going to start with the model structure, as I said, so anytime you go to any modeling course, what they're going to tell you is these very sort of basic things, and I'm going to repeat them because I think in practice they're actually quite important. So the main sort of simple idea here is that you really want to make your model readable, right? It sounds simple, but once you start building it, when you start getting layers on layers on layers, what you end up having is a big mess that's really difficult to separate. And especially if you're upkeeping a model that's been out, that's been there for years. A lot of analysts actually, and this is partially my experience, is a lot of analysts that have been working in Ukraine, for example, or even sort of any starting analyst, a lot of time they inherit models from other people. So they basically start working with a model that's already there. And God, some of these are really difficult. Like you try to untangle what's going on in the model. It's just sometimes, what I did a lot of times, just built it from scratch because it's just way too difficult to understand what the other person was doing. There's so many figures. It's really difficult. So how do you make it simpler for other people? Well, first of all, separate it out into different sheets, right? Separate your operations, so your operating data, your financials, your valuation, and definitely, most importantly, separate your assumptions into a different sheet. Because as I was sort of saying before, the important sort of idea in valuation is that you're going from assumptions to a value, and you have to make it very clear what those assumptions are, and you have to let people change those assumptions, manipulate them. In my practice, sometimes portfolio managers would ask you to send their models to them. And they would use these. Why would they use these? Again, they would just input their own values in there, in the assumptions, and they would get a figure, and they'll be like, okay, so I can work with this model. If you just give them a whole bunch of numbers, it's pretty much useless, right? And you've put in so much work into it. So make sure you separate out assumptions and really separate out all of these things into different sheets as well. Try to match columns. This actually, I figured out in a while that it's much easier than if you have different sheets, for example, right? And your column D is year 2010. Make sure your column D is year 2010 in other sheets. It's a simple remark, but it actually saves a lot of headaches and when you're looking for errors. Then color code. Very important, I think. Whenever you have anything that's calculated in your model, code it in one color, maybe leave it black or something. And if you have an input that you've put in by hand, put in a different color. Because it seems like whenever you're building a model, it seems like you will always remember where the figure came from, or how the figure was calculated. But trust me, in like 2 months when you come back and open it, you will not know. So use comments as well. This is another important thing. If you have a value in there that the company told you, for example, right, or you found somewhere, you looked it up online. I don't know. You looked it up in the statistics. Put in the comment who told you what it is. Leave a source, because next time you come back, it's just going to be a figure, and you're going to wonder, how I came up with it. So these are sort of the basic things. Now, one sort of big point that I wanted to discuss here is when you start out modeling, right, and you're looking at a company, and most realistic companies that you're going to look at are probably going to have more than one segment to them. And the way you want to structure your model is, so if you're facing a company that you don't really know that well, what you always want to start off with is you want to look at the financials of the model and look at the different segments. Especially you want to pay attention to divisions that generate the bulk of your EBITDA, because that's really what you're after, right? You're after cash flows, and cash flows are tied very closely to EBITDA, so profits. Always look for profits. And here I have an example, 2 examples actually. So on the left here, this is Metinvest, which is a Ukrainian steel producer. Probably most of you have heard of it. They have 2 divisions. One of them is the metallurgical division, which produces steel. They've got mining. Then there's corporate overhead eliminations, which I'll just mention a bit later. And on the right here, this is Kernel Holding. It's an agricultural company with a whole bunch of segments, right? They have bottled oil, sunflower oil sold in bulk, export terminals, farming, grain, silo services, other. So when you look at this, right, so this is a lot of people, for some reason, from my practice, a lot of people don't pay enough attention, in my opinion, in this part of the auditor's report. A lot of time, people will be looking at the 3 forms, and they would just ignore it because this is hidden somewhere in the notes. People would sort of go through it, and this actually opens up what the company does, right? From right away, for example, for Metinvest, right? You can tell, well, all right, so I have no idea. Say I have no idea what the company is, right? I can look. Okay, look, they make steel, and then there's mining, right? And most of this, if I look at the total here, right, I see that the most important segments are obviously metals and mining, right? So there you go. That's what the company does. If you look at kernel holding, say you never heard of the company, right? What does it do? Well, all right, so it has farming, right, which generated a whole bunch of EBITDA, right? This is actually operating profit, but so you should technically be adding the amortization and depreciation to profits and looking at those figures. But say this is the EBITDA, right? So you would look at this, and right away you'd be able to say, well, all right, so this is the big segment here, right? And this, and also this one, and maybe some smaller ones I don't really care that much about. So right away, you sort of have a good idea. Now, onto this, what I'd like to add is that, say you would start out, maybe I'll actually use the flip chart here. So suppose you wanted to model, MetInvest, for example, right? And so you would say, and this is what a lot of people do, and what I was doing at the beginning, is you start out and you say, all right, so they have an iron ore segment, right? So the iron ore. And then they have the metal segment, right? And the difficult thing here is that the iron ore segment, not only does it sell externally, right, but it also sells to the metal segment. And that means that the EBITDA that you're seeing here, right, the EBITDA unfortunately. But the EBITDA that you're seeing there is actually being generated not only by external sales, and also a lot of people are confused about this, but it's also generated by internal sales. And you have to keep that in mind. And when you're modeling, so what will happen is sort of if you're starting out, and the simple thing to do, right, is you model the segment here, you say, these are my costs, revenues, they produce some amount of ore. Then I'm going to model that some of this ore goes into metals. And then I'm going to say that metals are using this ore to produce steel. And so that's the way the model is going to be structured, which is fine. It works. But the problem with this approach is that it can actually get unbalanced really quickly. If you're not keeping track very closely of how much ore is being sold to the metal segment, for example, whether you're not selling too much ore here, how much ore is being sold externally, what can happen is that you can have one segment selling way too much to this segment, or, for example, the costs here can be too low. You're getting tangled into these into a very complicated relationship. And if you have like 5 segments, for example, right, you have to model the relationship between 5 segments, and you have to have revenues of one segment going into the cost of the other segment. That just makes it really, really hard to keep track sometimes. So what do? And I think this is sort of a practical result that I've sort of started using over the years, is that you really want to model every operating segment as a separate company. So that's really what it boils down to. Why is this useful? So and can you, right? Because again, some people are confused. Well, can I do that? Because it matters, right? Since, for example, if the mining segment sold more ore externally, right, it would give me different results. So how can I just ignore that they're selling to each other? Well, the reality is that EBITDA has a really nice property of being additive, right? So you can't add sales together because you're just going to get, so if you look at sales, right, you add them all together, they don't add to the total, obviously, right, because your internal sales are not going to add up. But the EBITDA does, right? So it doesn't matter. So for the metallurgical segment, it doesn't really matter if it's selling it, the mining segment, it doesn't really matter if the mining segment is selling ore internally or externally, it's generating that EBITDA. Moreover, if the company is, and this happens a lot of the time, is that companies use market prices between each other, right? So it's an arm's length transaction. And if that happens, then you're totally fine, right? Because each company is really functioning like a separate entity. And in reality, MetInvest, for example, if you take them, right? So what do they have? They have a bunch of steel mills, right, which are buying ore. They don't care who to buy ore from. They can buy ore internally, or from their own affiliates, or they can buy ore from other people, right? If you look at MHP, and MHP is a poultry producer in Ukraine, this actually is a good example, because what they have is they have 2 segments. They have a farming segment, which is grain, and then they have a poultry segment, which buys grain, turns it into meat, right? And then the poultry segment, so these poultry farms, they don't care whether they're buying grain from MHP or they're buying other grain. So from year to year, what you have, for example, is that if the grain segment is producing really high quality grain, what they're going to do is going to sell that grain externally, because it's high quality grain. They can get a better price on it. They're not going to feed it to chickens. They're going to feed it to people, right? And then they're just going to buy really cheap grain and use that. So from year to year, this is going to be very different. But really, in the end, your total EBITDA is going to stay the same. It doesn't matter what you're selling. So this is actually pretty key. And And yeah, and so I would advise, and this is pretty much says what I've been talking about, is that treat each operating segment as a separate business. You don't have to, as I mentioned, you don't have to keep track of where one segment is, whether one segment sold enough items to the other segment, what the interactions are. Just forget all that. You model them. The only thing you have to sort of, if you want to match, if you're building a full financial model and you want to make sure that your revenues are matching, right? Your EBITDA is going to match. But if you want to make sure your revenues are matching, you can sort of put in assumptions of how much revenue is going to be external, how much of it is going to be internal. But that's not that important, right? Because for a value of a company, what you really care about is profits, and profits stay the same. Yeah, so this is sort of the key idea here in modeling structure. And if you take anything away, just take that away. Model each segment differently. Next, let's look at the modeling detail. So let me take a sip of water here. Okay, so how detailed should your model be? And that is a question that I've asked myself a lot of times, and I think a lot of practitioners have asked a question like that, because it always seems like the more detail you put into your model, the better it is, right? The more impressively it looks. Let me ask you this: how many of you think that you should be putting as much detail as possible into your models? Maybe raise your hands. Anyone? As much detail as possible. So your model should be as detailed as you can possibly make it. Anyone think that? No one thinks that. All right, well, I thought that, right? So if you can put in more detail, your model looks more impressive. You're modeling things more closely. You're modeling, your operating segments in a more sort of correct fashion. What turns out is that there are actually quite a bit of downsides to having a very detailed model. And the answer to this question is actually, it seems straightforward, but the answer is that you want to have only valuable detail in your model. You want to have only detail that's forecastable, that is impactful, and that's forecastable. That's actually the key items here. So just to give an example, so I was doing this, I was modeling a lot of farming companies, agricultural, and what you end up having is if you look at farming, right? How is grain being produced? Well, so if you look at a per hectare basis, what are you putting in? You're putting in different fertilizers, right? You're putting in labor, you're putting plant protectors. So those are sort of the, and then there's, the fuel and stuff like that. So there are big categories there. But what you can actually use, you can break them down and you can say, all right, so they're using fertilizers. What kind of fertilizer are they using, right? They're using different fertilizers per different crop. So, let's break it down into fertilizers. And then we can go down and break those down even more into, what is the exact brand that they're using. And once you do that, your model gets really detailed, but you sort of ask yourself, can I forecast the prices of each fertilizer? I mean, can I really, is this useful at all? What ends up happening is that in the end, you just end up using a growth rate for all your fertilizers. You're just using the same one, right? Because there's no way for you to forecast which one is going to grow. In reality, they're going to be different, right? But what's also going to happen is that the company is going to choose the cheapest one. So it's sort of counterproductive, right? You're modeling the prices of every fertilizer, and then, or even different brands, right? Are they importing them or are they not? I mean, this is what happens when a company gives you so much data. And then in the end, what happens is that they're going to pick the cheapest one, and there's no way that you can tell how much, how much of each fertilizer they're going to use, what kind of a brand they're going to use. So that detail, it seems useful at the beginning, but really it's not. And it makes your model so much more confusing. It makes it so difficult to update. So the answer here is you want to contain useful detail. And I have some of the pros sort of and cons of having very detailed models. So as I said, the pros is that they reflect the business process more closely. Assumptions are broken down into more pieces, right? So if you give someone a model when you have your cost of goods sold, forecasted as a single figure, right? People are going to laugh at you. Like, is this a model? I mean, look, you're not really breaking down anything. So how can you be sure, if prices of fertilizers go up, how can you know that, what's going to happen to your costs? There's no transparency there, obviously. So you should probably break them down, but don't. It goes case by case, but only go as far as you can usefully say, right? That I have a forecast of where the fertilizer is going to go, right? So, for example, if you have if you have an exchange where you can see fertilizer prices, right? You can say, all right, they're going to use this type of fertilizer, and there's no way they can get out of using it. And based on this index, then I'm going to include this into my model because I have a good understanding of where this is going to be, right? So I can use this assumption. And it can impact my model in a meaningful way. So that's sort of the answer there. Cons, as I said, very hard to update. The bigger your model is, if you update it, it's just tons of work and not very useful. And another con that I have it here. So whenever you have a really big model, your valuation drivers can actually get lost. And the way this works is that we have so many inputs in there that in the end, right, you're getting a figure, and if somebody comes up to you and asks you, why for example are your costs growing 10% per year? You're going to be like, well, I'm going to break this down. I'm going to look at this and that, and then if you have we have 30 inputs. It's just so hard because they're all different, based on different assumptions. It's just a whole bunch of different drivers, and none of them are really clear, right? So there isn't a very clear reason why your costs are growing, just because a whole bunch of different small assumptions just added up to growing. That can actually be very impeding because you don't really. It's hard to explain why this is happening. So when you have a simpler model, you can always say, my costs are growing 10% because because I'm assuming, the fertilizers are growing at 40%, right? And then there's a very clear link. If you're saying, well, I'm assuming that some of my fertilizers are growing at 3% and others are 15%, or am I wrong? Right? Am I wrong? Very hard to keep track. So yeah, that's that. If you are, and this sort of links to the previous section, if you're adapting a 20-80 approach, and this is sort of an approach where you spend 20% of the time to get 80% of your result, what you also want to do is, this concerns model detail, is you want to look at operating segments that generate a meaningful EBITDA, right? See, this is DTEK, by the way. This is DTEK is a big energy producer in Ukraine, well, the biggest in heat coal generation, coal power generation player on the market. If you, for example, right, you don't really know that much, say, about this company, but you want to model it, and if you want to sort of start off, right, and you want to do it, as quickly as possible, efficiently as possible, look at the segments, right? Look at this. So they have a total. The segment result is 14.9 million. I think this is in millions of hryvnia. So 14.9 billion in EBITDA in total, right? So let's look at these segments. Other, right? 71. Who cares about this? This is just an error, right? So forget about it. Oil and gas, 410. Forget about that as well. Renewable power generation, forget about it. Heat generation, well, 5 billion. Okay, well, sorry, 900 million. Maybe if you have the time, right? Electricity distribution, if you have the time. But really, this is it, right? That is what you should be modeling. That's really what all of this. All of this is nice, but what you can do is you can just set a growth rate to this if you're doing it quickly. If you have the details, again, as I said before, if you have useful detail, right? If the company is actually giving you the way electricity distribution works and how the margin here works, and you can model why the margin is this and not something else, go ahead and model it. If you can't, forget about it. It's not that much, right? So look at this. Concentrate on this. This is going to be driving the bulk of your cash flows. It's going to be driving the bulk of your results. Focus on this. Another thing I wanted to mention is working with limited information. And I think this is very applicable to Ukraine. It's very applicable to actually what I heard in the previous example, the previous speaker, right? What she was talking about is that a lot of companies don't really give you good information, and it's a problem, right? And it's a problem that every practitioner faces. And how do you sort of get out of this? Is there a way? How do you model a company where you don't have so much data? And actually, every time you're facing this, the biggest difficulty you usually have is costs. Companies are really afraid to give out costs because they think that it's very a very sensitive information. They're hiding them. They're afraid to give them out. Sometimes they just don't have really good data on costs because they just lump everything together, and cost is basically just how much money was put in. It's easier to keep track of volumes that are sold, and it's easier to keep track of prices, so that you can usually get. But costs and anything else is a lot of the time is a problem. So what do you do here? I mean, how can you deal with a company that you don't have much information about, but you need to build a model? What do you do? The answer here is actually margins. So here you go. This is it's actually I use this now a lot of the time whenever I model. Whenever I model companies like like DTAC, for example, they don't give much information. I mean, talk to them. They're just going to give you very little. There's not a report. You can see what the prices are, but costs. That's going to be really hard. So here you go. I mean, what can you do? You can. The simple thing is that you can say there's a simple equation that cost per ton is equal to price per ton minus the EBITDA per ton. And that's actually kind of interesting because it sort of lumps your costs together, and you would think that this is not useful, right? Because, well, it has administrative costs and it has everything in it. How is this useful? Well, why is this useful? So for short-term forecasting, for example, the really cool idea about costs, they're actually fixed in the short term. So if you're forecasting short term, just assume the costs are fixed. If you don't know anything, right? Assume they're fixed. And then the price is actually going to drive the bulk of the difference. This is where your change is going to be. So if you're forecasting, say, even a couple quarters ahead, you can just assume costs are fixed, or you can assume the costs are maybe, you can adjust them. So I mean, one way to do this. Let me draw here as well. Right. So say you're modeling, I don't know, again, Metinvest, right? You have steel. And these are your COGS per ton. You know what they are, right? So what you do is you take the price of steel, right? That is available. You take your volumes, right? You calculate the average price that they're selling at, right? So you divide revenues by the volumes, you get the average price. And then you say cost is equal to EBITDA per ton minus the price per ton minus the EBITDA per ton. And then, right, so if you don't know anything else work with that, it actually works surprisingly well. If you know more, well, there you go. So you know that ore, for example, goes into steel, right? So you can find out how much ore you need per ton of steel, right? So you can use that. And then once you have that, you can say, well, look, so say this is period 0, right? And I'm moving on towards period 1. And I know that from period 0 to period 1, my iron ore went up by, say, 20%, right? If you know you can calculate the share in the costs, and you can say this, right? I'm going to use the old costs, and then I'm going to just change them. I'm just going to assume that everything else stayed fixed, and what didn't stay fixed is what I know, right? Is that I know that iron ore got more expensive. So I'm just going to add on to these costs the impact of a 20% hike in iron ore, right? And actually very useful, surprisingly close. You're getting to the figures very close. So it works. It works pretty well. So this is what you can do if your information is very limited. Again. These are some of the things I sort of picked up along. One other really interesting idea here, actually, is that margins are actually even more meaningful than it seems at the beginning. So margins, and this is something that maybe that's not very obvious, is that margins are actually very stable over long periods of time. Oh, sorry, go back. Yeah, margins in absolute terms, and this is really crazy. So look at MHP, for example, right? EBITDA per hectare. So you know that prices for grains. So into hectare for MHP, for example, a whole bunch of grains go in, right? Corn, wheat, sunflower, all that goes in there, and then they have costs, and it's difficult. It's actually very difficult to model. But in the end, look, I mean, your EBITDA per hectare is actually mean reverting, right? Look at this. So if you don't really know anything about MHP, what you can say is, look, I know how many hectares they're planting, and I know that EBITDA is mean reverting, for whatever reason, but it's mean reverting. I mean, look at it, right? It's mean reverting. So most likely it's going to be around. So if this year they had a bit more than $300 per hectare, next year it's going to be a bit less, right? It's going to stay around $300 per hectare. So go ahead and just multiply your hectares per EBITDA per hectare. That's actually pretty stable, right? And there you have it. I mean, this is actually pretty fascinating because it allows you to model a company without really not knowing anything at all about it, right? If you know that its margins are mean reverting, and when either are they mean reverting? Actually, they're mean reverting when you're looking at a company that's working on a market with an absence of structural changes. I'm going to give an example on the next slide when there are structural changes, and you'll see how that works. But I mean, look at for Expo, for example, and this is a big pellet producer in Ukraine, right? So yeah, the margins are jumping around, but really, I mean, they're not jumping around that much, and this is really crazy because if you look at the pellet price, it's right now it's around 90, it's gone to a low about 40, and at a peak it was like 160. Right, so crazy. But look at this. Look at the margins. They're fine. They're not that crazy. So obviously here, when you're going up way up here, I mean, you don't have to be a genius to say most likely it's going to go down. So why does this work? I mean, by the way, look at this MHP poultry EBITDA per hectare. Right. So this is the EBITDA of their meat production per kilogram. Right, in Ukraine. And this is in Ukraine, right? So they're selling their meat on the local market. A whole bunch of inputs from here going to here. It's a very difficult process. But in the end, look at this. It's pretty stable. That's just that to me is fascinating because really it's a really complicated process. Why is this happening? So why does this work? I mean, really the reason this works is because in the end, margins are actually more important than revenues and costs. Because if you ask yourself, for example, if you take MHP, right, and their poultry segment, what happens when the price, so for example, when the price of grain goes up, right, when their costs are going up, what's going on in the market? What happens in the market is that other players, their production costs have gone up, and what happens is that either they increase their selling price, right, or they have to close their capacities. But if they close their capacities, then there's an insufficient amount of volumes on the market, and prices go up because of scarcity, right? So really, margins are actually driving. A lot of the time, it's margins that are driving the prices, and not vice versa. You would think that the price determines the margin, but really, it's the other way around. I mean, another way to think about this is that if you're building a poultry farm, or you're doing any project that sort of makes you money, you're always looking at a rate of return, right? You're going to be investing in a segment if the rate of return on your investment is sufficiently high, right? So if it turns out that your margins are down here, right, and it's not profitable to enter the market, you're not going to enter the market, right? But if the margins are super high, what are you going to do? You're just going to build more capacities because everyone wants a piece of the money pie, right? So they're just going to go into the market and they're going to create more supply, and the margin is going to go down, and that's really what regulates this. So, sort of a big idea that I'd like you all to take away from this, and this is something that again fascinates me, is that a lot of the time margins, which seems like a shortcut. I mean, this seems like a shortcut to a lot of people. It's like, well, it's really easy, just take EBITDA, divide by volumes. You're not really an analyst if you do that, but really, you are, because you can really see a lot of the time that margins are actually more important than costs. They're more important than prices. They are the driving factor behind the whole. That's the heart of the business. And as I promised, so an example here of what happens when structural changes are present in the market. It doesn't work, right? For example, this is Kernel Holding. They are a sunflower oil producer, as I was saying, and they are a grain trader. So what's going on here, right? Margins are going way down. It used to be over 300. Now it's close to less than 100, right? 3 times. What's going on here? Why isn't mean reversion not working here? Well, because there is structural shift on the market. What are they? Well, in this case, you simply have more crushing plants entering the market. So they're there, right? There's a limited supply, or more or less limited supply of sunflower seed on the market, and this is in Ukraine. So when you have more power plants entering, crushing plants entering, they compete with each other for the same resource, and in the end, you have shrinking margins. But ask yourself, why did they enter the market? Well, look at this. So per ton, back in 2008 or even 2009, per ton, kernel was making $250. That is insane. If you look at the rate of return on a crushing plant at this point in time, it's just huge, right? I think it cost something like $500 a ton or something to build. So in 2 years, you basically get your investment back. I mean, wow, right? Really good investment. So just go ahead and do it. And that's what everyone thought, right? So they did it, and now they're here. Right? And from this point, well, what's going to happen? Eventually, you're going to have mean reversion. You're going to have stabilization of the margins when it doesn't make sense to leave the market. So and here, what's going to happen is you're going to have inefficient producers with really small plants. They're going to leave. And this is actually what Kernel is telling people, and I've been telling people for all this time. They saw their profits dwindling. They're like, well, at one point, it's going to stabilize because all the inefficient guys are going to leave, and we're going to stay, and the margins are going to come back. Well, they're not going to come back to this level, but they are going to recover somewhat when inefficient small players leave, and the market is going to stabilize. Really similar thing for grain trading, new players entering. So know the market. So if you know the market, if you can answer yourself the question of are margins mean reverting, are there structural changes in the market, you're actually halfway there, right? So if you take MHP again, right, go back there, you say, well, all right, what does MHP do? Well, it produces grain, it produces poultry. How much poultry is it selling per year? I don't know, 500,000 tons. How much farming does it do? 300,000 hectares. Multiply one by the other, done, right? Your EBITDA is complete. Build a model, assume that your EBITDA is more or less the same. I don't know, maybe add a growth rate onto it. In 5 minutes, you build a model. It's actually not that terrible. And if you actually compare it to what other analysts have with a whole bunch of sheets, you're going to get something pretty reasonable to that. Not as good, obviously, but it's not that bad. Yeah. All right. So with that done, how much are we? 40 minutes. All right. So this is a bit of a heavier segment here. So what I'm going to talk about here is the modeling method. And it's more theoretical. It has more to do with how you should be discounting cash flows whenever you're building a model. What you see a lot of time, and actually most of the time, is that most practitioners, and actually I think from what I've seen, over 90% of practitioners are using the free cash flow to firm. Why? Because everyone has been using free cash flow to firm. You get a model. A lot of time it's legacy. You get a model that's free cash flow to firm. You discount it by a WACC. A lot of people don't really know what the WACC is. We're going to talk about that. And also, so they do that, and then they discount it by the WACC, and they're done, right? What is the problem there? Well, the problem there is actually pretty big errors are introduced when you use the WACC incorrectly. What do I mean by using it incorrectly? Well, to answer that, let's first answer the question of what the WACC is. And yeah, this is a pretty heavy slide here. Okay, so in the end, I'm going to sort of just run to the formula here. This is the formula that everyone's familiar with. I'll go through the derivation a bit. I think we have time to do that. It's actually not that hard. So this is the formula for WACC, right? And if you ask a lot of people, what are they doing? So they're saying, well, so we have equity value times so this here is the cost of equity. So it's the equity times the cost of equity plus debt times the cost of debt times 1 minus t, and a lot of people have no idea what the 1 minus t is for. They're like, well, because it's just there. I'll talk about why that is. And then they divide it, and then it's like, so what do you use for debt? Well, I took the balance sheet value of debt. What is the equity doing here? I mean, isn't this confusing? I mean, it seems like you're using the value of equity in order to calculate, so you're trying to get at the equity value, right? But you need the equity value to calculate the WACC. How does, I mean, that's kind of weird, right? If you think about it, I mean, you're trying to get here, and you have to use this to get there. Weird, right? So people say, well, I'm going to use the market value of equity. Well, it turns out that's wrong, actually. You can't use the value of equity, and this is the reason, right? So I'm going to try and sort of go through this. It's not that difficult. Let's see. So what am I going to say? Let me first answer the question of what the WACC is. So the WACC is actually, it's the discount rate that you need to use in order for this to work, right? In order for this equation to hold. So that's actually, so what does this mean here? It's the discount rate that should be used. If you're using a free cash flow to firm, this is what you should be discounting your free cash flow to firm at to get at this value here. And what does this mean? So okay, let me maybe write this down. So I'm just going to assume that everyone knows what the DCF is like, and I'm going to say this, all right? So the value of equity is, right? So it is your free cash flow to equity, right? Divided by 1 plus, say, KE is the cost of equity, right? So this is in year 1, FCE of year 2 squared, and so on, right? This formula should be familiar to everyone, right? So that's just you're discounting your cash flow anytime, right? Anytime you're deriving value of anything, the value of any asset in the world, right, is the discounted cash flows, right? It's how much cash it's going to provide you, discounted by the discount rate, right? So this is your equity. This is really what you're getting at, right? So when you're valuing equity, this is what you want to do. And if you say that, right, the same thing for debt, right? So debt is the debt cash flows 1 plus KD plus D2 1 plus KD squared and so on, right? If you say that these are true, right, and you know these to be true, the question is, say your EV is your enterprise value, right? What do you need to discount it for? And these are your free cash flow to firm, right? 1 plus flat, this is 1 free cash flow to firm, 2, 1 plus y squared, right? So really, to answer the question of what the WACC is, right, it's just this discount rate, right? This is mathematically what you should be discounting your free cash flow to firm with in order for your equity value plus your debt value to equal the cost of the cost of the firm, right? To equal the firm value. That's it, right? So that's really it. I mean, you can sort of say it's a mixed discount rate, blah blah blah. It has a meaning. Really, I mean, the only meaning it has is that it's just mathematically the rate that needs to be used in order for this to happen. So from what you have here, right, and that's just how the derivation works, right? You start off with so this is your equity, in a different way, right? Equity cash flow 1 plus the discount rate plus that equity, second t plus 2 equity cash flow divided by 1 plus ke t plus 1 and ke t plus 2, right? This is just assuming that your rates here can be different. The same thing goes for. Same thing goes from the next period. If you combine these two equations, what you get, this is the sort of the intertemporal form of the same thing I have on the over here, right? This is just the intertemporal form of the same thing. So you wrote that out. You wrote the debt out. A very important thing actually here is that this formula only works, and this is one of its limitations, is that if your cash flow to debt needs to be your debt multiplied by your cost of debt minus the change in debt, right? So to think, what is the way to think about it? It's your interest rate plus the change in debt, right? So if you're a debt holder, what you're getting from the company, you're getting your interest rate plus if they're amortizing your debt, you're getting the cash from that, right? So this has to hold. But the funny thing is that what has to happen is that your cash flows to debt holders have to match the cost of debt. Otherwise, it doesn't work, as you'll see, right? Because all of this has to hold for the formula on the next page has to work. So this has to work in practice as well, and it doesn't. A lot of the time, for example, your balance sheet debt, your balance sheet cash flows your income statement cash flows of interest rate are not going to match your cost of debt, right? Because, for example, if your company placed the bond, if it placed your bond at par value, yes, your coupon is going to be the same as your interest rate if the market conditions don't change. But a lot of times you have market condition changing, and your debt is now not trading at par. If you're not trading at par, what you're getting is your yield is not the same as your coupon rate, and and the formula breaks down already, right? So over here it breaks down. Yeah, and as I was saying, so we go on and we write the intertemporal form of the equity of the enterprise value. That's over here. Same thing, right? If you look at this equation, they're totally the same. This is just the enterprise value, which is equal to the equity plus debt. And here, your free cash flows to firm. This is the definition of your free cash flow to firm. So it's your equity, right? It's your equity cash flow, and then you have to add in your debt, right? And this is the after-tax one. I'm not about this tax shield that everyone hates. And then from here you have a negative sign here because if you're acquiring more debt, right? You're gonna have if your debt is growing, then that means that you're getting funds, and if you're paying down debt, then the free cash flow to firm. Then the free cash flow is growing. So what is this term here? The term here, and this is the same term over here that everyone is wondering about. Really, really, it's just convention. What is the convention here? The convention is this: you are evaluating the free cash flow to firm of an unleveraged company by the leveraged WACC. That's sort of why you're doing that is just beyond me, right? It's easier, just forget about this, right? Include your tax shield, which is so confusing. Just forget about the tax shield. Just calculate the normal free cash flow to firm, and then you just discount it by normal WACC, and you can be done like that, right? You won't need that. So if you know how the formula is derived, you can just forget about this. It's historical, and the reason this sort of happened here because there was an academic sort of debate of what the tax shield is. Should it be discounted by the equity value, by the equity cost of equity? Should it be discounted by the cost of debt? By the combined one? The debate really led to this term being here. In the end, you can take it out, make your life easier. Take it out of here, take it out of here, and and it works. So now that, and look, I think this presentation is going to be available for people after, right? So if you're confused about the way this is derived, you can sort of look at it yourself. It's just for now. If you didn't follow this, just trust me that the equity value plus the debt value, in order for it to equal the enterprise value of the firm, you need to be discounting your free cash flows to firm by the WACC, which is this formula. Simply, it's a mathematical equation here. So, what's the implication, right? So we've gone through all of this, and what is the implication here? What are we saying really with this? What we're saying is that we're getting into problems when we use the WACC incorrectly. So what are the conclusions? So this equity here, it's actually as you can see here, it's not the market value of equity. It's the fair value of equity. So this is the term that you're getting at. So the whole talk is about valuing equity, and this is what you want to do. You want to value equity, and so what the free cash flow to firm approach does is it evaluates the enterprise value, and then you're subtracting your net debt to get the equity value. But really, as I was saying in the beginning, you need the fair value of equity to calculate the WACC, and you need the fair value of debt, right? So it's really counterproductive to do this, and in fact. You don't know what the equity value is without calculating it first. So sort of in the end, this boils down to a simple fact that you actually need to know, and here's an example. This is a practical example, just something I thought of. These are numbers, just to demonstrate that these approaches are the same. Here is your discounted FCF by the WACC over here. As you would expect, it would give you the same thing as your debt, right, and your equity. This is your equity value calculated for each time period. This is the fair equity value. And this is when it works, right? This is when your equations are the same. So what happens if a lot of the time you would have people saying, all right, I'm going to assume my WACC is 17, and I'm just going to put it out there. Your result is going to be way off. When we're talking about discount rates, errors have a huge impact on your valuation. Just very, 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 very big. So whenever you're using the WACC and you're not using, the way you're supposed to be using, you're not using the equity, the fair value of equity, and your debt cash flows, your fair value of debt is different from your cash payments on debt, right? From your cash interest rate. Whenever they're different, your formula is way off. Your discount is just mathematically incorrect. That's a big deal, right? If you look at what people do, just take any company and open it. 95% of the time they're going to be using the free cash flow to firm. They're going to be using some sort of a stable WACC, and they're going to be wrong. So here is involved. You have to calculate the fair value of equity first in order to use the WACC. Well, if you're going after equity value, why would you calculate equity value first and then look at the WACC and then discount one more time? You would not do that. Just go ahead and calculate the equity value, right? Just discount your free cash flow to equity at the equity discount rate, and you're done, right? Forget about the rest. Why? It's more correct, right? And you need to do this. There's no reason for you to basically, if you just want to draw a conclusion, just don't use the WACC, right? Use the free cash flow to equity, and that's it, right? And you're going to get the result. Another error that's introduced a lot of times is in the growth rate, because people often include a growth rate, they put a growth rate onto the free cash flow to firm. What happens is that whenever you're using the WACC, in order for it to work, you have to assume that your debt to equity ratio is fixed, right? So if your free cash flow to firm is growing, your debt has to be growing as well. And what does that mean? That means that your free cash flow to equity has to be growing even more, right? And in this example here, that's just the one I thought of, right? And again, hopefully later on, if you're interested, you can just look at the figures yourself, because if I go through all of them, we're just going to take way too long. But in this example over here, right, and you can see here that the interest rate is fixed, but your tax rate is changing, and your cost of equity is also fixed, but you are acquiring debt here. right? So you're starting at 200, then you pay down the sum, and then the debt is growing, and so your debt to equity ratio is actually different at different points in time, and that's the reason your WACC is different. But if you sort of put in a 3%, a lot of people use 3%, the magic number 3 to use in your terminal value. If you just put that in your free cash flow term, it actually translates into 5.5% in free cash flow to equity growth, and that's actually very aggressive. Your equity cash flow is going 5.5% growth for the calculation to be correct. That is pretty aggressive. So if you want to stay on, and this is one of the pitfalls actually, you put 3% in here, sometimes it's going to translate into 6%, for example. You're assuming your free cash flows to equity are going 6% per year for the rest of eternity. I mean, yeah, that's one reason. That's one reason your terminal value sometimes ends up being, like 80% of your valuation because that. Yeah. So bottom line, use the free cash flow to firm. Hopefully, I've convinced you. If not, go back to all these equations, look at them yourself. Hopefully, it makes sense to you. Yeah. So that's sort of the first point on the valuation method. Now, the other important idea here, and again, I'm going to bore you with formulas for a little bit, is determining the proper cost of equity. So we've decided, right? So if we go along the sort of the thought route, we've decided that we're not going to use the WACC. We're going to use the cost of equity. And now we're saying, all right, so if we're going to use the cost of equity, how do we know how do we calculate the proper cost of equity for a company? And this is what practitioners face all the time. It's like, what should my cost of equity be? And what do they turn to, right? And in a time of crisis, they turn to the CAPM, right? This is a formula they remembered. It was written down. It sort of gives you what your equity premium should be. So let's use it, right? Why not? I mean, this formula works. Well, it probably doesn't really work. That's sort of the problem with it again, right? Why doesn't it work? Well, actually, I'm just going to answer. It doesn't work because it assumes so many things that are not realistic. That's the short answer. And the long answer is here. Yeah, some formulas again. So, all right. So, why does the CAPM fail? And there are a lot of proofs of the CAPM. I think a lot of people have never seen a proper proof of the CAPM. Here I have a sort of. I think it's more. It's not a really strict proof, but I think in theme it works. Actually, I'm not using a microphone. Maybe this is a problem, but I haven't been using it for a long time, so whatever. Hopefully, the voice is being recognized somewhere. Is it? Should I be using it?
I don't know.
Can you hear me fine? Yeah. Okay. Because all right. Okay. So here, what we have here is a sort of a derivation in spirit of the CAPM, and it's going to sort of pinpoint the reason it fails to work in practice. So let's look at this. So whenever you're looking at any market, right, and if you say you have a portfolio where the risk-free rate is present, what you can always write your portfolio as a sum, right? As a sum of, let WI stand for the weight of every asset. So you have I assets in your portfolio, right? You have N assets in your portfolio. So RI is a return on asset I, and WI is the weight of your asset I in your portfolio, right? So you can write it as the sum of returns. Returns are additive, right? So as long as these weights add up to 1, you can do that. And then the risk-free rate as well. So in the presence of risk-free rate, you can write the return on your portfolio as the return, as the risk-free return plus the sum of the weights of assets I, where times the difference of the return on I minus RF, right? So you can see why this equation holds, right? So you simply combine the two equations. And then so the expected return on your portfolio would be this. I mean, so this should be pretty simple so far. Mm-hmm. Now, if you calculate what the marginal contribution of a risky asset I to the expected portfolio is, what you would do, right, is you would take the derivative of WI. Hopefully everyone knows what the derivative is. So you're saying, if you change your WI by a small amount, how does the return on your portfolio change? And this is the result, right? So you can, again, if you remember that when you take a derivative of something, basically this term here has turns into 1, right? So drp dwi equals simply this fraction here. Hopefully that's clear to most people. I hope it is. So you took the derivative, right, to asset I, and this is what you're getting here. This is the marginal change of your portfolio's return to the weight. And you can do the same thing with the risk, right? With the variance. So if you remember that the formula, the variance formula is say you have two assets, right? W1R1 plus W2R2. If you write out the variance, it's W1 squared variance of R1 plus W2 squared variance of R2 plus the covariance of R1 R2. And if you imagine, right, so your portfolio consists of I assets, you can sort of write out this matrix. So it's not a very strange matrix. It's just a big sum over here. We just put it into a form that's usable, where your sigma 1 squared is your variance, R1, right? Your sigma 2 1 is your covariance. Just notation. So covariance is sigma 2 1. This is the covariance of R1 R2, and then sigma squared is the variance of R2. So you're going to get all of these terms, right? And the sum of all of this is going to be, if you write out your variance of your big portfolio, right? That you're going to have to add up all the terms. But we're only looking at the sensitivity of your variance to your asset I, right? So the sum of the entries in the ith row. So if we're going for 2, for example, portfolio 2, right? You would have to consider all of these terms, right? And all of these terms, and that's going to be the total contribution of asset I to the portfolio variance. And this is it. This is how it's going to look like, right? Why? Because, well, there's only going to be this one variance term it's going to do over here. And then over here, you're just going to have 2 times all the variances, right? Imagine that if you had 3 variables here, this would just be a longer equation, right? It would be W1 squared variance 1, plus W2 squared variance 2, plus W3 squared variance 3, blah, blah, blah. And then you're going to have just a bunch, all the permutations of the variables. This is it. This is your shorthand notation for that same thing. And so when you take the derivative of the weight with respect to the variance, what ends up happening is all you get is the 2 covariances here. That's it, right? So it's just you just take the derivative of Wi over here, right? So what are you getting? You're getting the 2 sigma squared I plus, right? You're going to get 2 times everything where I does equal to j of sigma j ij, and the only term that's missing here, right? This I is equal to j. Is when I is not equal to j. When I is equal to j, it's exactly this term over here. So if you add up this term into the sum, what you're getting is this, right? So you're getting this, and then you take the derivative of this with respect to well, you take wi with wj, whatever you want to call it, and you're getting this covariance here. So what does it say? This says that the sensitivity of variance in your portfolio to the weight of any asset is the 2 covariances. Now, if you're looking at optimizing a portfolio, what you want to be looking at, right, so here's actually one more term that you need to look at, is you want to be looking not at sigma squared because this is the variance, but at the standard deviation, which is the square root of the variance. So you take the derivative of that, right, of this term here, and what you're getting is your covariance of Ri or P has to be divided by the variance of Rp. This is what you're getting. This is just simply the result of taking the derivative, right? Mathematically, hopefully, again, clear to people. So when you're when you're maximizing your portfolio, what you want to be looking at is that what has to happen, right? Is that you want to compare your marginal return to marginal risk, and if you write it out, right? So going back here, what's your marginal return? Ri minus Rf. What's your marginal risk? It's sigma ip over sigma p. So when you put these terms together, the funny thing is, right, is that if you're maximizing your portfolio, the marginal, so in an optimal portfolio, the ratio of marginal return to marginal risk must be the same across all included assets. And here, basically, is sort of the groundwork and the most important assumption that the CAVM is making. Why is this true, right? So why does this work? Because, well, what are you really assuming here? You're assuming that you're dealing with an optimal portfolio, and the CAPM is assuming that the market is in equilibrium. And why, if you're in equilibrium and you have optimized everything, why does this have to be constant? Well, because if there's any asset I, which is lower than this term over here, right? Which is, for example, if some of your assets have a higher marginal return to risk ratio than some other ones, then get rid of those assets in your portfolio where the marginal return to risk is lower, right? And replace them with assets where the marginal return to risk is higher, simply, right? So you will do this, you will be reshuffling your portfolio where you're getting the maximum amount possible of your marginal return to marginal risk ratio. If it's not a constant, if it's not the same across all of your assets, then you should be rebalancing your portfolio. And what the CAPM is assuming is that this is the reason why the CAPM is assuming that you are totally imbalanced. So, and then so from here, once this is constant, right, you can say, all right, so this is also true for the mortgage portfolio, and then your CAPM is right here. So really, what are you assuming here? So the biggest assumptions are that you're in total equilibrium. In order for this to happen, you have to be in total equilibrium. You also, so the market portfolio that everyone talks about is basically, you have to assume that all your investors are rational. They have the same optimization, they have the same utility function. They're optimizing the same problem, the same sort of, they're optimizing the same equations, they're solving the same optimization problem, and they're investing in the same portfolio. So this is the reason why there's just one market portfolio. Everything is balanced, everything is optimized. All the investors know what the returns are. Everyone has solved this problem. Everyone has balanced the portfolios, and everyone has a portfolio, and it's the same portfolio where the marginal return to marginal risk ratio for every asset, every asset on the market is the same, right? And if that's true, then this formula holds, right? So obviously that's not true in reality, right? Not every investor bought the same portfolio. Not every investor has the same preferences. Not every investor has maximized the same, has solved the same problem. So the whole mechanism of how these assets mean, and by the way, what's the driving force behind the CAPM? It's prices, right? It's the idea that if certain assets are disliked by investors, their price is going to go down, and therefore the return is going to go up. So this is going to be happening until a return is sufficiently high for the risk that the asset is bringing in. So your price is the balancing factor here. And so obviously this doesn't hold, right? This doesn't hold, your market is not balanced, I'm not going to the same portfolio. And empirically, if you look at the empirical research, and this is the US market from over the last 30 years, you'll see that it doesn't really hold. So this is the portfolio beta here. This is the average risk premium, right? I don't know what risk premium is, the RM minus RF times the beta. What you're seeing here is there isn't that much of a correlation. You will see some works where people have found correlations work, but really over the grand scheme of things, it doesn't really work. So now now we've sort of shown why theoretically it doesn't work, right? Because the way the assumptions that are needed to derive this formula are actually kind of strict, and they're not applicable to real life. It's a useful theory, and because everyone is optimizing their portfolios, and the risk premium, it also sort of tells you that your asset, if you look at the beta term, right, when it looks at the beta term, is that what you're paying for, right, your risk premium is proportional to the covariance of your portfolios, of the returns of your portfolio to the returns of any given asset. And yeah, that sort of works in reality, right, because you only care about covariance, since the reason you only care about covariance is because of this term, right, is because the marginal impact of an asset I onto your portfolio, the marginal risk impact onto it is given by the covariance term over here. Right? That's why the covariance term is in there. Again, hopefully you have time to look at this in detail if it interests you. But yeah, this is actually, see, I didn't use the big sort of curve derivation that everyone is using, right? When you draw sort of your efficient market frontier, blah blah blah. That's I feel like this is a more intuitive reasoning is here, and this is sort of the heart of what the CAPM sort of describes. So anyways, yeah, so here's this is your market portfolio here. Empirical research shows that it doesn't really work. So what do you do? What's the solution? Well, the solution actually is change your approach. What does this mean? Well, the relationship between the cost of equity and the fair equity value is actually the same as that between the price of a bond and its yield. And this is, I think this relationship over here actually it sort of shines a light on why you don't ever know the cost of equity, because I mean think about this, right? If you know the fair yield of a bond, you're pretty much done, right? You already priced the bond. That's the only thing. You know the cash flows of the bond, right? That are given. You know the yield of the bond, the fair yield, and so you're done, right? So that's it, right? Your valuation is finished. The same thing works for equity. If you know the fair equity value, right? Yes, you have a problem. The hard thing about valuing equity is that you have two unknowns here, right? You have the cash flows are unknown and the discount rate is unknown, right? Both of them are known, but it doesn't make you know the discount rate, right? It's another parameter that you simply don't know, and there's no way for you to pinpoint down to it. What happens in bond markets, right? How do people deal with this in bonds? Well, they look at spreads, right? And this is actually kind of, it's really bad picture here, but this is sort of the kind of work that I'm doing right now, right? Is I'm looking at spreads, right? This is the spread. This over here, right? Is the government's Eurobond curve, and then we have corporates over here, right? And you can calculate the spread between each corporate and the sovereign curve. And then you can say, well, I mean, what do people do in the bond market? They say, well, this spread is too big. Why? Well, because I feel like it's too big whenever I look at, whenever I look at Forexpo, say, right? Because Forexpo produces iron ore, and Metinvest produces iron ore and steel. Why is the spread between the sovereign curve and Metinvest so large, whereas the spread between Forexpo and the sovereign curve is so small, right? Maybe there's a mispricing going on here, right? So that's what people do in bond markets. I mean, that's pretty much it. You have some other approaches, but really, that's it, right? You just look at the spreads. So think about this. I mean, this could be. No one does this in practice, but this could actually be an approach for equity as well. I mean, if you assume certain cash flows, right? If you have a model for a couple of different companies, what you could do, you could draw the same picture, right? You could have your cash flows. Here you would have your duration, for example, right? Or actually here you could have your here you could have your duration. Here you would have your return, and then you would be looking at the yield, right? And you would be saying, is the yield on a certain company higher than on a certain other company? So it's really, these are basically two parameters. There's no good way of knowing. What you can do, right, is you can, in the end, right, we come back to this beginning idea, is that your valuation is about the method, right? It's about the method. And your cost of equity is a one big input that you pretty much have to assume, right? You can assume some more or less realistic things. For example, you can look at the cost of debt of the company, and then you can add a premium, right? Because we all know that the riskier your cash flows are, the higher sort of return you have to be asking for. You can do that. You can look at some other interest rates that are determined on the market. Hell, you can look at the bond market, right, and say, well, obviously the cost of equity has to be higher. But that's about it. I mean, that's really it. You can then sort of give to people the different assumptions. In the end, what I do is I give people a table where you have your cost of equity assumptions and then your different prices. That's pretty much as the best you can do. Yeah, so what's the sort of conclusion here? What are we drawing from here? What we're drawing is, don't just sort of blindly use the cost of equity that you've calculated with the formula that doesn't work. I mean, give people the assumption of what your cost of equity is. You can honestly say to people, I don't know what a proper cost of equity is. That's the reality. No one knows what it is. So give people the cost of equity, and then show them how sensitive your model is to it. Obviously, it's really sensitive, but give them a couple of assumptions, different assumptions, and they can decide for themselves. They can look at the company and say, well, I feel like this company should be giving me a return on equity of 15% because there's another company over here that's giving me a better return or a worse return. Everyone's going to decide that for themselves. So don't don't go there. So use the cost. Use free cash flow to your equity. Show what your cost of equity assumption is, and that is the cleanest valuation that you can have in terms of the way it works. So yeah, that I have finished. How much time do I have? So maybe 15 minutes, another. Okay, so we're done with the method. That was sort of the hard part with a bunch of formulas. Now, this is more practical again. We're going to come back to more practical things. So some other really common pitfalls is whenever you look at, whenever I look at models, what I see a lot of the time is, so this is one big issue, earnings that grow out of nowhere. What does this mean? Well, a lot of the time, people don't have capex in their models, which compensates for depreciation. So what's going on is that you're basically using assets and you're assuming, and you're not putting in money to uphold them. That doesn't work, right? You have to make sure this is there. A lot of times this is missing. Make sure that the company's investment projects are reasonable in terms of return. Whenever you have a big model and you assume capex, a lot of the time people are not going to check what is the impact of that capex on the company's cash flows. Right? They're just going to put it in. But what happens a lot of time is that the value of the company becomes generated by unrealistic capex assumptions. Right? So you assume that it costs you 100 million to build a plant, and then the plant adds on a certain amount of cash flows to your firm. If you don't actually look separately at your project, what you may end up happening is that you have sort of inadvertently added in a term that makes your model completely unrealistic. So make sure, if you're modeling capex, make sure that you have looked at capex, you have looked at the rate of return on your capex separately, right? And that you have made sure that it's actually realistic, because that can have a big impact. Using unrealistic price assumptions. This happens too. People sometimes put in, my price is going to grow 5% per year. Why is it going to grow 5% per year, right? Good question. Are your costs growing about the same rate? Are you making sure that your margin, even if your margins are growing 5% per year, why are you assuming something different? And this sort of goes into one of my very first points when I was talking about sort of the general things, is that if you're going against the market, for example, if your iron ore today costs $80 or $60 a ton, that is the result of millions of people trading this commodity, right? People that are part of the market, people that are part of the iron producing market, people that are part of the iron consumption market, they are forecasting and they believe that today's fair price for ore is $60 per ton. Whenever you're assuming something different, you're pretty much going against the market. If you're an iron ore guru, right, and have been working on the iron market for years and know that the market is inefficient for some reason, go ahead and do that. If you don't, the market is, believe the market is most likely more right than you are, right? Because if the right assumption for the price of iron ore tomorrow is, or in a month, right, is $100 per ton, people are just going to buy iron ore today because it's going to be much more expensive tomorrow, right? So today's price would adjust to reflect the future price. So what does that mean? Today's price is really the best estimate of your future price. That's what the market believes the future price to be. And so use that, right? So if you use today's price plus the cost of, you can use some sort of like a futures thing where you assume the cost of money from point A to point B, and then you just assume that your price increases at the cost of money. That's a reasonable assumption. But don't assume your prices are going to grow in some weird fashion, because there's no way to justify that, and you just, you're saying that the market doesn't know better. Forgetting about currency risk, it's applicable to Ukraine a lot. If you have a company that's in Ukraine and it's getting its cash flows in hryvnia, make sure your cash flow risks are reflecting that, because you don't want to be discounting your hryvnia or any currency, right? You want to make sure that your interest rates match currency. And this actually goes into your cost of equity. If you're a company like Kernel, for example, right, that's most of its cash flows are in dollar terms, you go ahead and use dollar rates. If it's a company that's located locally, make sure you reflect the currency risk, because it's there, it's present. How big it is, you can judge, but don't forget about it. That definitely do not forget about that. Yeah. So relative valuation. I'm just going to touch on this. This is sort of another the easy approach to valuing companies, right? Why is this easy? Because you basically take the EBITDA and you say, I'm going to multiply the EBITDA or your net income, whatever ratio you're using. I'm going to just multiply by the market ratio, and I'm going to say this is what the value of my company is. Yeah, you look at the market, pretty good. A lot of the time, what happens is if you do a DCF and you do relative valuation, you will see that they give you slightly different results. And the question is, why are they different? I mean, what should you be doing? Should you be taking averages? maybe a weighted average? How should you sort of read this? What you should do here? And I've seen a bunch of different approaches. A lot of times people like to take averages and say, I don't really know which approach is better, so I'm just going to average the two. Well, is that a good approach? I would say no, it's not. Why is it not? Well, you want to make sure that ideally your DCF and relative valuation should be telling you the same thing. If they're not, figure out why. Right? Why is it not giving you the same thing? What's going on there? Is there a reason why this is not happening? I mean, obviously, if you did your DCF and it's showing you that your fair EV to DOM multiple, for example, is 5, and you look at the market and the market is saying 3, right? Well, something's wrong, right? Either the market, either you super right, which is possible, right? Or maybe you're not right. And if you are right, again, go back to the other issue and sort of ask yourself, why is the market undervaluing this equity? Is there a reason why it's not being valued correctly? And moreover, what you will actually see a lot of times is that there are reasons, and the most important answer usually is that your country risk is there. So whenever your multiples are lower than your analogs, what you see, or your peers, is that the peers that you're getting are not located in Ukraine. They're located in other countries where risks are simply lower. So there's going to be a risk premium on your assets. Obviously, your multiples is going to be lower. So some of the common pitfalls, right? Your peer group does not operate in the same industry or environment. It happens a lot of time. People they go to Bloomberg, they just pick something out that looks sort of like the company they're valuing. A lot of the time, they don't look closely enough and they can be completely different. Definitely, they're in developed markets. So make sure you understand that because it's in the developed market, it's going to have a different multiple. Financial year periods are not matching. This happens a lot of times. Well, whenever you have a company that finishes its financials in June, for example, this happens in agriculture actually a lot, and you're comparing to companies that finish their financial year in December, different figures. So go ahead and remember that. Earnings metrics are calculated on a different basis. This is actually huge, and I'm going to dedicate a little piece, a little piece of, just two more slides actually, to this. So sometimes what you have, this actually from Adamant, this is true, they include their JVs into their EBITDA. So the JVs are not consolidated into the company, but they have a big piece, they have a big investment in them, and so what they do is they give you this EBITDA, which includes JVs. And when you compare it to other companies, they don't include JVs in their EBITDA. Your multiple is just going to be so wrong, right? Totally different multiples. Revaluation effects. This happens for agricultural companies a lot. Really, other sectors as well. Agricultural especially, there's something called the IAS 41. Again, I'll talk about it just a little bit more later on. And then this other thing, which is kind of difficult and really obvious, is that whenever you have a company where the functional currency is different from its reporting currency, for example, if you look at MHP, they report in dollars, but the functional currency is the hryvnia. What happens is when you have a lot of devaluation, your company is demonstrating basically carry EBITDA additions, which it wouldn't be having if the functional currency and the reporting currency were the same. You have to think about it. It's kind of complicated. I'm not going to sort of basically talk about this for too long, but it's interesting because you get really weird things. If you compare MHP to Cardinal, for example, Cardinal reports in dollars, and its functional currency is in dollars, and it's actually reporting lower margins than MHP was back when the hryvnia was valuing. So something to keep in mind as well. And here's a very practical example. When I was actually working for Renaissance Capital, I wrote sort of a research piece on the relative valuation of this IAS 41 term, which is biological revaluation. What is this? I'm just gonna maybe just say maybe 2 words about it. Biological revaluation is whenever you have biological assets in an agricultural balance sheet. What sort of the IFRS board figured out at one point is that they want to value them at fair value. So if you have a field, for example, right, or you have a tree, fruit tree, that's growing, right? If it's growing, then you can have zeros in your income statement for like 5 years until it grows and actually produces something. So in order to avoid that, what they said, let's value at fair value our biological assets. And when you do that, what happens is that you're including profits, which are not really profits, they're not really cash profits, but that's just half the problem. The biggest problem is that companies, there's a lot of leeway on how you calculate biological valuation, and companies have been using it very aggressively to boost their earnings. And here's an example. So this is all the companies, and this is how many agricultural companies actually traded back in 2008, 2010. So if you look at them, right, so there's the valuation here, there's the adjusted EBITDA is one that's adjusted for revaluation. Here's accounting EBITDA, which is not adjusted, and this is the difference here, right? So you can see that for some companies, the difference is 88%, right, 86% over here. So huge, right? So your multiples are going to be way, way off. If you just take your accounting EBITDA, which is the EBITDA the company gives you, and you calculate a multiple, you're going to see on the next slide how much it differs. Same thing with net income, right? It also impacts net income. Look at net income, 110% difference. 110% difference. That's insane. 192%. So really, your multiples are meaningless, right? If you just use the accounting figures, your relative valuation is meaningless. Doesn't mean anything. Forget about it. Just cross it out. You have to make sure you are comparing it on a comparable basis. And these companies, they're all agricultural, they're all in Ukraine, but this thing is happening to them. It's really crazy. The average share, right? This is median share of biological valuation in net income. 46%, 30%, 20%. Big. How does this impact multiples? Here you go. Percent difference, right? So say you were valuing a company and you ran this, right? And you'd say, I think that, I don't know, that one of these companies is overvalued, right? You're saying, I think that KC Agro is overvalued. Well, look, there's 20% difference between your multiple and the real multiple. So that sort of takes away a big chunk of what you calculated your fair value to be. Look at RIA. This company. It's actually kind of interesting. I go back here that companies that no longer exist have really big valuations because they were actually boosting their earnings with these figures. So basically trying to convince investors that they're making much more than they are. RIA, look at this. 37% of your EBITDA over here. 41% of your EBITDA is being calculated, is relative valuation. Some of the other ones, look at Adamant. Ooh, that company no longer trades. 192% of your net income is valuation. So yeah, be very careful when you use multiples. Look at earnings. Make sure the earnings are calculated on the same basis. You really have to dig into your sectors, and you have to know what's going on in your sectors, how the data is being formed, and especially pay attention to non-cash, where EBITDA is departing from its cash equivalents. Pay attention to why it's happening, what's going on, are they revaluing something? That is huge. Make sure you're doing that. Okay, so that's roughly it. I hope this has been informative. I'm open to questions if you have any. Yeah, thank you. Go ahead. Questions? Anyone? Yeah.
Actually, it's very interesting, especially for me. I'm serving as a judge for the research challenge, so now I'm much more equipped to. I have a question about the cost of equity and the model, because I was valuing mainly the financial companies, and that's where you use only cost of equity. There is no leg there. So, as far as I understand, when you're using the CAPM model in countries like Ukraine, there is another problem besides all the fundamental issues that you mentioned. There's another problem that you need to have a very robust long-term data set to really apply CAPM, and that's what we usually in Ukraine lacked. All the data either bad or not enough. And so again, if you remember how we did that, we applied this method of calculating cost of equity, starting from risk-free rate and then adding all kinds of premiums, calculating the generic equity risk premium, and then adding other risk premiums, which in theory, if you spend a little bit of time, you can justify statistically, try to justify statistically, but usually we did that without doing that. But I mean, what do you think about such approach?
Yeah, sure, definitely. As I was saying, right? So the simplest thing you can do is you can look at bonds and add a premium. If you want, you can try and sort of add a country premium. There used to be an NDF, right, which you could which you could use on the Virginia, for example, right? You can look at the country risk. You can compare your sovereign bond yield to your U.S. bond yield, for example. That's going to give you sort of a country premium. You can add on all the different kinds of premiums. Really, just I think what's important to keep in mind is that none of this is set in stone, right? None of this. If you want to be if you come to this from an academic standpoint, it doesn't really work, right? You can't really justify it because as I was saying before, well, if you know the cost of equity, you also know the price of the company, right? So, really, it's sort of the same. It's approaching. It's the same thing as valuing the company, right? So. There's no really easy answer to this. I agree with you that it's a reasonable way. I think what you're basically saying is you want to somehow justify this term, and so you're going to say it can't be bigger than this, it can't be smaller than this, most likely, right? And I'm going to narrow down sort of this the range as much as I can, right, and say that it's reasonable if it's within these bounds. I think that's a reasonable way to go. Sure, yeah, definitely. Obviously, investors are going to expect to get a bigger premium for companies that they are getting in debt markets, right? And they're not expecting to have something insane. So, yeah.
Do you believe that there is statistical data that there is an intrinsic equity risk premium for any equities over debt, and that it explains? And if you use the U.S. market, it's usually about 4 to 5% overall equity risk premium.
Yes, definitely. I think what definitely holds, right, is that investors, and this is pretty obvious, right? Investors are going to ask for a higher return on a higher risk asset, right? That's just common sense, right? Because why would you risk more to get less? That's just stupid, right? No one's going to do that. So obviously, you're going to ask for a higher return. So yes, definitely, there is a risk premium on more risky assets, for sure. No doubt about it. Just the question is, can you use this? Are you safe if you use this? Can you use it and say, well, the CPM gave this to me? Not really. That's sort of the point that I was making. But what the CPM does hold, right, is the fact that what's even more, right, as you were talking about this premium, is that the only justifiable premium really is the covariance, is the rate that's not diversifiable, is the undiversifiable rate, right? And that also makes sense, right? Because if there is a risk that you can diversify away, you shouldn't be getting a premium for it. That's mispricing. Mispricing obviously happens, right? But sort of logically, yes, you should only be getting paid for something that you cannot diversify away. That is true. It definitely works in markets. Sure. So the whole. I'm not trying to sort of disregard the whole idea here, right? What I'm trying to say is that this equation fails to work, but it doesn't mean that the whole sort of logic and the whole of sort of modern finance fails. It doesn't. It works, and whatever sort of logically makes sense holds true. That for that, yeah, definitely. Any other questions? Anyone? Yeah.
If we used, instead of KPM, for example, 3-factor or 4-factor models, incorporating size premium and value premium, would it overcome these inefficiencies, or has such 3-factor or 4-factor models some superior qualities to ordinary KPM model? Yeah.
Well, look, to answer your question, I'm just going to say this, right? So, the I think it's called the APT, right? When you add in other terms. So to answer your question, would it work better? Well, let's first answer the question: why would you include other terms, right? How did it come about that people started including other terms? Well, what happened is that people were running regressions. This is a regression that you can run, and they were seeing that it doesn't work, and they were saying, all right, so if I just treat this as a regression, what if I add in more terms, right? Will I get a better model, right? Will it work better? Will it fulfill sort of more assumptions of least squared regressions? Will it fail less? Is it going to have more predictive power? What people found is that sometimes it does. It has more predictive power, definitely. Sometimes, but sort of the question is. You always have to, whenever you run regressions, I generally have a problem with regressions because Well, first of all, most of the time they fail critical assumptions, right? So whenever you take a bunch of data and you use a regression, what you end up doing is that you're running it, right, and it sort of gives you a best fit, but really fails critical assumptions all the time. So it doesn't, and why? Because it doesn't really explain the process. So what you would have is you would adding out of terms, you would get an equation, and that equation would hold for the data that you're using it at, but it doesn't mean that it's going to hold for other data, right? And that's the problem with these kinds of regressions. So to answer your question, do I think that it adds validity? Well, I think it explains how the market has been behaving with respect to certain companies at a certain period of time. It would explain that. But would it give you predictive power? I'm doubtful, right? And actually, if you look, this is from Fisher Black, and the work they've done, they looked at average risk premium, they looked at this relationship in the past 30 years. If you go back, they actually have a period from 1930s to 1960s, and you can actually see there that there's much more correlation there, right? So that's weird, right? So the CPM seemed to work for 30 years and then it stopped working, right? Why? Well, because the data simply, the data that they gathered followed that trend, and now it doesn't follow the trend anymore. So can you maybe make up a model where it would fit? Can you have a sort of a best fit that would fit into these points? Yeah, you can do it. Does it have predictive power over other markets? Not really sure. I don't think it does. Yes.
My question is about market approach valuation in a situation where your target company you're trying to assess is a private one, and your selected peer companies are public companies.
Yeah.
What do you think about application of premiums for lack of marketability and discounts for lack of marketability and premiums for control? Do you apply them?
Yeah, definitely. This is true. So you should be applying some sort of premium, right, to your discount. Definitely. Again, to answer your question, is there a good way? Not really, right? I think what you should be doing is you should be saying, look, so this is the cost of equity that I would be applying if this was a publicly traded company, right? And this is the risk premium that I would be applying. But really, I don't think it's that easy to justify any figure, right? Any figure that you give to people, they're all going to have their own understanding of what it is, right? Because I mean, look at Ukraine, right? In Ukraine, if you have a private company, the risks of a private company in Ukraine are so much bigger than they are in the US, for example, right? Where markets are much more controlled, where rule of law is much larger, right? If you're trading, you have a company that's trading on international exchange, the risk, minorities are protected so much better than they are if your company even trades on the Ukrainian exchange. If it's private and you're a minority, God, I wouldn't even invest in a company like that. But it always depends on the price, right? So it should be big. The discount should be big. How big? I don't know. It's hard to justify. So pretty much you can justify a lot of different figures. I would say leave it up to if you're doing this for a buyer, for example, if it's an M&A transaction. Give them your assumptions, right? Say this is what we think is reasonable. I mean, if you're trying to sell it to them, right, then obviously you want to value your company as much as possible. So tell them this is what we think is reasonable. But they're not gonna, if they're a proper investor, they're gonna make up their own mind on this, right? So they're gonna use their own assumptions. And this sort of goes back to the question of what is valuation? Valuation is a tool, right? So you build this tool for them. You include a way for them to sort of include a risk premium for the fact that the company is private. And then, put something in that makes sense to you and give them the possibility to play with the model and to, fit what they think is reasonable. They have their own idea. So that would be my question. My answer, sorry. Any other questions? All right. Well, thank you very much. I hope this has been helpful to at least some of you. Happy to answer any other questions just in private. All right. Thank you.
Thank you.